Hello and welcome to BQ Prime. A very good morning to all the viewers. In fact, I would say good evening to Arvind Sanger, Managing Partner at Geosphere Capital, who joins in as well late at this hour with his time zone to give us more information of what this entire scenario with regards to Credit Suisse would mean for the markets. Welcome to the show, Arvind.
Thank you.
Arvind, my first question coming to you is now that UBS is taking over Credit Suisse, this is one of the historic deals that we are seeing, and it actually follows collapse of two large US banks last week that actually spurred a frantic, and there have been broad responses from the US government as well to prevent any further panic. What would this actually mean, for the markets from an overall perspective?
I think the markets might take a little bit of comfort that disaster has been avoided, but I think the risks in the financial system are more about fear about contagion than look. Most of these banks, the ones in the U.S., the problem was not that they made bad loans or they invested in bad securities. They invested in government bonds, treasuries. They invested in mortgage-backed securities, which are fine. It's just that because interest rates have gone up, mark to market, if you did that, their value has gone down. But if you hold them to maturity, they're all going to be fine. So the problem is one of this short-term confidence and people wanting to take money out. And if they can get very good interest rates in government bond markets, they don't want to leave it in banks. So this has become a short-term risk. And I think avoiding a disaster like Credit Suisse going under is helpful. But it's not like it's the magic bullet that is going to fix all problems. I think we're going to continue to have to deal with this. And I think the only way to deal with it is banks are going to have to issue more equity to build up the equity cushion to give people comfort that even if their bonds are worth less temporarily, the banks are going to have adequate capital adequacy to be able to go through this high interest rate phase.
Right. So, Arvind, would it be right to say that this entire deal with UBS coming in as a stronger, player as for a takeover actually puts a halt to the crisis from a short-term perspective, at least, in terms of the contagion spreading further and getting deeper, but it's not a long-term solution. From a longer-term perspective, there will be a lot of things that will have to be solved for.
That's right. Well, it solves the immediate problem, but even the short depends on how the short term you define the short term, right? So yes, it may be good for today, for 2 more days, but I think there's a question about First Republic Bank in the U.S. There's a question about other banks. So I think this might take a couple of weeks to play out, and I think there'll be some new capital raise. But I don't think. Let me be clear about one thing: this is not 2008. This is not a financial system that has made a lot of bad investment decisions. It's just that the interest rates have risen so fast that some of the mark-to-market, securities look less attractive. So, the reality is this is going to force the banks, the financial institutions, to be more cautious about lending, which means that's going to tighten financial conditions, which means they're doing Fed's job, but which also makes a recession more likely. So let's talk about the real world and the fear. The reality is that as financial conditions, when there's so much insecurity, the banks will lend less, and therefore a recession becomes much more likely, both in US as well as in Europe, where other financial institutions are seen as somewhat less challenged than Credit Suisse, but still not completely in the clear.
Right. In fact, an interesting point that I was seeing over there is the entire term of the deal is where, we are seeing UBS has agreed to buy the rival Credit Suisse for 3 billion Swiss francs. That's $3.2 billion. However, the Swiss National Bank has also pledged a loan of up to 100 billion Swiss francs, which is $108 billion, to support the takeover. Do you read between the lines on this kind of an arrangement?
Well, I think it's a backstop. Basically, it has to give comfort to depositors, to the high net worth wealth, clients and others. It may never need to be used. I hope it doesn't need to be used because these governments don't have unlimited liquidity. But what it gives, hopefully, the goal of these governments is to give their talk in the U.S. of increasing the amount of guarantee for all security deposits. All of these big amounts of money are involved in terms of what the government is pledging, but that's not money out the door. That's money available to give depositors and other people who have money in these banks to have comfort that they don't need to draw it because there's a lot of money available. So this is more about making a big bazooka visible, but hopefully never having to use it.
Right. And Arvind, it's very interesting to see how the Federal Reserve and the Treasury Department have actually welcomed the deal, as has the European Central Bank. It's interesting to see how both of them are actually talking, coordinating to act. I mean, and it's unlike what happened in 2008 as well. What kind of signals do you get out of it?
Well, I think in 2008, after the Lehman, failure, I think the global central banks and governments did coordinate because it was a global contagion. And so they did coordinate after that. So the lessons of 2008 are being applied here because the coordination did take place after the crisis broke out and the global financial system faced challenges. Since then, whether it was the Greece challenges that Europe faced or other things, I think the global central banks do talk more frequently, and they did define 30 global institutions that were too big to fail, of which Credit Suisse was one. And therefore, Credit Suisse has significant presence in the U.S. And in other parts of Europe. It's not just a Swiss closed loop institution. And therefore, I think what you're seeing is the necessary coordination between different major regions where Credit Suisse has significant exposure and significant counterparty exposure. So, it's not an island, so it has counterparty exposure to investment banks in the US, to the banking system in Europe. Therefore, I think, yes, this coordination is helpful. And again, this is part of trying to give people comfort that, that the central bankers, but the reality is, all of this coordination is only preventing a meltdown, which I don't think is coming. I think there is enough coordination, but it's not going to be able to prevent a recession, in my opinion.
Right. So, Arvind, if you see from a market perspective right now, right? Clearly, Asian markets are really not really happy with the deal. That's what it looks like, because we are seeing Asian markets which have opened lower. Why do you think that's the kind of scenario?
I don't know if it's that Asian markets are not happy with the deal, but I think Asian markets, when they closed on Friday, things hadn't fallen apart as much as when the US and Europe was open on Friday. So Asian markets are actually catching up with what happened on Friday in US and Europe. And if you look at the US market and the European futures, they're showing a moderate rally from the Friday sell-off. So I think Asian markets are just, it's a time difference that is playing rather than just a commentary on this deal. If you look at the US futures, they're up a little bit right now. But I don't think, again, my point is this is not a magic bullet panacea. And I think Asian markets and others are currently worrying that what is the next shoe to fall and what is the heightened risk of recession. I mean, so therefore, markets are not going to go on a party because of this deal.
Right. And what's the kind of impact you're seeing with regards to Indian markets as well overall? Because, clearly from a banking perspective, a very small portion is in terms of operations for a Credit Suisse. But higher exposure for foreign banks is specifically with regards to interest rates, as well as if you talk about, the bond market as well as the forex market, right? So are you seeing any impact coming into the Indian markets from this perspective?
Well, let's talk about two different or three different things, one of which you raised, but the other two that I want to talk about first. Firstly, the Indian banking system and the Indian NBFC system went through its own crisis a few years ago because of the IL&FS and other, bad loan challenges. So the Indian banking system is actually on the other side of the crisis in terms of having gone through some tough times and being in much better shape. So I think the Indian banking system is fine. I think, the Indian economy, however, is not a complete island. It will be affected by global recession. So I think that part could hurt. And then when you're talking about money flows and, and risk off, risk on, I think, there will be a certain amount of risk off in uncertainty. Again, I'm not talking about today, but over time. So we've already seen outflows from emerging markets, including India. But I think, once the dust settles on all this, yes, we are probably likely to have a recession in the West. But India as an economy, I think, is relatively low exposure. It has exposure, but it's less than many other emerging markets to to global trade flows, because it's a much more domestically focused and service focused economy. And therefore, I think I can't say for this week or this month, but over time, Indian markets should be able to weather the storm of whatever is going on in terms of global economic slowdown.
Right. So that's a broad perspective, from a recessionary point of view. Coming to the banking part, are you, or even for that matter, IT as a sector, do you see a major fallout?
No, I don't think so. I mean, well, look, IT will have, IT sector will, because if the financial institutions are merging, consolidating, there will be less business, there'll be more uncertainty. It's not a time when, financial institutions are going to be focused on, how much more they can outsource when they're kind of hunkering down and, trying to cut costs and manage. So IT sector, which, for which BFSI is a major client, will be somewhat negatively impacted. There are other trends at play that are beneficial, but in the short term, the IT sector will feel a little bit of pressure. The banking sector, as I said earlier in India, I think is fine. And I forgot to mention one other thing, Indian inflation data has been okay. I mean, it's not terrible, but look, India has been used to high single-digit inflation. It's lower than that now. The West is not used to the kind of inflation we've seen in the last 1 year for several decades. So therefore, it's not something that is outside the realm of something that the system can deal with. And Indian inflation, is a little bit stubbornly high, but it's stubbornly high at levels which are not terrible in terms of global, and its own history. So I think the Indian banking system is fine. I don't think we have to worry about any contagion from the global banking stresses showing up in the Indian banking system.
Right. So, and how do you see the impact with regards to the bond markets as well as the forex markets?
Well, I mean, I think the forex market could see some outflows, but I don't think it's terrible. Again, I think a lot of the outflows have already happened in terms of some of the risk off in emerging markets. And the bond markets, let's look at the fact that bond yields have come down a lot. Bonds have rallied because the expectation is that the Fed will be cutting rates in a few months, maybe 2 or 3 months. And if that's the case, then the bond markets are rallying, then the Indian bond market should benefit from that, because of bond yield differentials are getting larger as the U.S. Treasury yields and other yields in Western safe havens are coming down. Then the Indian yields look better. So I other than the risk off element, I think the bond yields going down and the bonds rallying globally is good for the bond market. And I don't invest in Indian bonds, so I can't speak to the day-to-day, but I look at the equity markets, and bond yields matter as an alternative safe haven. But I would expect that bond yields going down in the US is good for Indian bond yields.
Right. And in fact, we have the US Fed monetary policy outcome as well that will be awaited this week. What's your anticipation? How do you see a change in stance, or do you see they maintaining the trajectory that they have, taking into consideration what's happening across as well?
Well, I think it's a very, very topical and very interesting question, because a week or 10 days ago, the consensus was that Fed was going to raise rates by 50 basis points. Last week, ECB did raise by 50 basis points, but ECB did that because they're so far behind the Fed, they are playing catch up. They did that despite the Credit Suisse stresses. I think the Fed's decision is a more difficult one, because, as I said earlier, the financial conditions, what is the purpose of raising bond rates? To tighten financial conditions, to slow the economy down, to slow inflation down. But if the banking sector stresses force the banking sector to slow the economy down by slowing down lending and what have you, then they're doing Fed's job. So the Fed may not need to raise rates. So if I were to say today, I think it's a 50% chance they go 25 basis points, 50% chance they do nothing, and almost zero chance that they go 50 basis points. So that's off the table. And it's kind of a toss-up, depending on what happens over the next 2-3 days. Does the turmoil continue? Does it start to settle down? I think it'll be a close call, because inflation, I think the expectation is that slowdown will help contain inflation.
Absolutely. So I think there are a lot of moving parts. Yes, this deal has come in as a savior overall to, have, to negate the further downside. But long term, yes, a lot of things that need to be watched out for as well. Arvind, anything apart from this that you think we've missed from a Credit Suisse as well as the entire financial crisis perspective that we're talking of? Because yes, it's not a mirror of what we saw in 2008, much better handled probably, but anything that you think we should be on the watch out for?
No, I think we should be now looking for signs of tightening financial conditions, tightening lending standards, all of that. But in terms of this crisis, I think we will see some U.S. Banks taken over and some capital raising by other banks. So I think we should still keep an eye on this. It's not over by any stretch, but hopefully, the contagion risk is lessening as governments and central banks are stepping forward.
Right. Thank you, Arvind, so much for joining us on the show, because this has been an interesting conversation. A lot of developments, across the last couple of sessions, and we don't know where to watch out for, right? And now
Yeah.
from here on, let's see what's in store for the markets globally as well. Thank you. Stay safe and speak to you soon
Thank
again. And
you.
good night.
Thank you.